All right, let's talk about MicroStrategy. You know, the company that's pretty much become synonymous with Bitcoin. But what if the real story here isn't just about them holding a ton of Bitcoin? What if it's about a financial machine, one that's specifically designed to amplify it? Today, we're going to dive deep into a purely mathematical argument, one that points to a price target for their stock, MSTR, that sounds, well, almost impossible. So yeah, let's run the numbers.
And this quote right here from analyst Adam Livingston really sets the stage for everything we're about to cover. He's basically saying, hey, this isn't about your feelings or what the market sentiment is. No, this is about pure mechanics. It's just arithmetic. And his claim is really simple. If you're bearish on MicroStrategy, you're either betting that Bitcoin is going to completely fail, or you just haven't done the math on how this company actually works.
And this is the number that the math spits out, $8,000. That's the base case price target per share by 2035. Now, to put that into perspective, from where the stock is today, that's something like a 48x return. I know, it sounds absolutely absurd, which is why we're going to break down exactly how the math supposedly gets us there, piece by piece.
Okay, so here's our game plan. First, we're going to look at the biggest if in this whole thing, the core assumption about Bitcoin's growth. Then, we'll get into the 3 levers MicroStrategy uses to juice those returns. After that, we'll dive into their most controversial and maybe most brilliant secret weapon. Then we'll ask, what if this base case is actually too low? And finally, we'll tie it all together and see why this might matter for you right now.
You know, any big, complex financial model really just boils down to a few key assumptions. And for this one, man, everything, and I mean everything, hangs on just one number: what you think the future growth rate of Bitcoin is going to be.
So to get some context here, we've got to look back. Historically, Bitcoin's compound annual growth rate, you'll hear this called CAGR, has been hovering around 70%. Now let's be clear, that is an absolutely mind-blowing number. It really shows you just how volatile but explosive its growth has been since the very beginning.
But here's the thing. The model we're looking at, it doesn't even touch that 70% number. Nope, the entire thesis is built on a way more conservative figure, a 30% annual growth rate. Livingston calls this his safe bet. And you can see why, right? It's less than half of what Bitcoin has actually done historically. It's basically building in a huge assumption that things are going to slow down a lot as the asset gets more mature.
Okay, so what does that safe bet actually get you? Well, if Bitcoin just compounds at 30% a year, this model projects a price of, wait for it, about $1.21 million per coin by 2035. Yeah, a massive number for sure. But it's important to remember that's just the direct result of that one single core assumption.
But hold on. If MicroStrategy was just a simple wallet holding Bitcoin, we wouldn't be talking about a 48x return, right? That massive outperformance, according to the theory, comes from that financial machine I mentioned, a machine that has 3 distinct levers. So let's pull back the curtain and see how they work.
So here they are, the 3 big levers. First up is leverage. This is pretty straightforward. The company borrows money to buy even more Bitcoin. It's a big reason the stock is usually more volatile than Bitcoin itself. Second, you have something called Bitcoin yield. This is the key. It's their ability to actually grow the amount of Bitcoin that's backing each and every share over time. And third, there's the premium. This is just the idea that the market is willing to pay more for a share of MicroStrategy than for the raw Bitcoin that it holds.
Okay, so that second lever, the Bitcoin yield. This is where things get really interesting. It's the most fascinating for sure, probably the most controversial, and, according to this thesis, the most misunderstood part of their whole strategy. And what powers it is a mechanism that, at first glance sounds like the worst thing in the world for shareholders: dilution.
The term you need to know is accretive dilution. And yeah, it's a total paradox. Because normally, dilution is terrible for an investor, right? It means your slice of the company pie is getting smaller. But this whole argument hinges on the idea that MicroStrategy has somehow turned this negative into their secret weapon.
And this really breaks down the difference perfectly. On one side, you have standard dilution, which is bad for you. A company sells new shares to pay for stuff like salaries and marketing, and your piece of the pie shrinks. But then you have what MicroStrategy does. They sell shares, and this is key, at a premium for one single purpose: to buy more Bitcoin. Think about it like this. Let's say they sell a new share for $1.50, but that share only represents $1 worth of the Bitcoin the company already owns. Well, that extra 50 cents they collected, that's used to buy more Bitcoin for everyone, including all the existing shareholders. So even though the number of shares goes up, the amount of Bitcoin per share actually goes up too. Your ownership gets richer, not weaker.
So, okay, that's the base case, right? You take a 30% annual growth for Bitcoin, you run it through those 3 amplification levers, and you land at an $8,000 stock price. But what if that safe bet of 30% is just wrong? What if it's actually too conservative? Well, this is where the numbers start to get really, really wild. Like from another planet wild.
Just look at how powerful this amplification structure is. If Bitcoin's growth is just 5% faster, so 35% a year instead of 30%, the price target for MicroStrategy almost doubles to around $15,000. And if you bump that up to 40% a year, which remember is still way below the historical average, the target just explodes to over 21 grand a share. That is the insane power of compounding those levers.
And it doesn't even stop in 2035. I mean, to really see the theoretical limits here, the model gets pushed all the way out to 2045. And even in a floor scenario, where the whole MicroStrategy machine just breaks down and it trades like a plain old Bitcoin wallet, the stock could still hit $40,000 a share just based on Bitcoin's growth. But in the upside scenario, if that good dilution engine keeps chugging along, the theoretical price hits an almost unbelievable $241,000 per share.
Okay, I get it. Those numbers are absolutely astronomical and they're decades away. So let's pull all of this crazy long-term math right back to today. Because the argument is that the market right now is offering a pretty unique opportunity, a potential screaming buy signal. And it's all based on one of those 3 levers we talked about.
It all comes down to that third lever, the premium. Remember that. It's just what the market is willing to pay for MicroStrategy stock on top of the raw value of the Bitcoin it holds. And historically, that premium has been pretty high. We're talking people paying $2, sometimes even $3 for every $1 of Bitcoin the company had. But right now, that premium has shrunk all the way down to just about 1.17x. The stock is trading for just 17 cents more than the actual value of its Bitcoin.
So the argument here is actually pretty simple. The premium is basically sitting at its absolute floor. There's really not much further for it to fall. But the potential for it to just snap back to its historical average, that's huge. And here's the kicker. This means you could see a pretty big jump in the stock price without the price of Bitcoin even moving an inch.
So when you boil it all down, this entire model really hinges on a couple of core beliefs. You have to believe that Bitcoin will continue its long-term growth, and you have to believe that MicroStrategy's financial machine will keep on running. The math is definitely compelling, and the logic, well, it's pretty clear. But it leaves us with that ultimate question. Is this a brilliant, misunderstood financial engine, or is it just a massive, high-stakes gamble whose success is anything but guaranteed?